Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, August 10th, 2017. I wanted to highlight a few things that stand out to me, after weeks and weeks of just, a grind, a slow grind higher to sideways or even down, depending on what index you're looking at. The small caps and mid caps have been moving lower, but the broad caps, I'm sorry, the broad market, meaning the large caps, the S&P 500, they've moved up. Um, but I think this video is timely. And before I get into these charts, and I'll run through them pretty quickly, I don't want to make this a long video. I just want to highlight some of the things that stand out to me as potential trading opportunities right now. Um, I won't go for everything that I'm following, but before I get to that, I want to say that the recent volatility, the extreme lows in volatility, and the extreme lows in the trading ranges, the daily gyrations in the market, have been at near historic low levels over the last few months, and although I've been doing this for quite a while now, and I've seen periods where we've had low volatility and the market seems like it's going to do nothing and bores you to death. You become complacent. Swing traders can't profit. You can't profit when the intraday gyrations are, less than 1%, and the trend is pretty much flat to slightly higher. I mean, sure, you could have made a little bit of money there, but again, the risk reward wasn't there. It just wasn't worth it. But what I wanted to get at here, to just wrap this up, is as a swing trader or a trend trader or even an investor, but mostly, as a swing trader, which is my primary trading style, the periods where you make money, it's not a consistent daily basis. It's not like ring in, I'm going to make X amount a day, steady Eddie. No, the market presents opportunities, and you have to be ready to jump on those opportunities. And sometimes there's only a couple, handful, two or three a year, two or three really big ones, and at times even maybe one big one that can make or break your entire year. I mean, you can get in, on a rip like after the presidential elections. I wish I had, positioned long and stayed long that whole time, but just using that example. And as I often talk about, the market falls a lot faster than it rises. Now, with all that being said, everything, and I mean everything I see in the charts tells me that if we get an explosive move anytime soon, big 5, 10 plus percent swing in the market in the next few weeks, months, it's very, very, very unlikely to be to the upside, and that's just based on everything I've seen in the charts. The big explosive upside moves come after corrections, they come after downtrends, they come when the market is completely caught off guard, as it was back during the U.S. presidential elections when Trump took the White House and everybody thought that Hillary was going to take it. So that was a complete 180, threw a lot of players upside down. Market players, shorts had to cover, longs jumped in. And my point being here is that you don't see explosive upside moves come from this. Anything is possible. I'll acknowledge that, but from my experience in looking at the charts, the potential for any big move is clearly skewed to the downside. Now, so with that being said, get your ducks in a row. Whether you're a long side only trader and you just want to protect profits that you've ridden this move up, or you're a short side trader or flexible trader like me, long and short, and you're ready to jump on anything, just have your sectors and your trade setups ready to go, because I've seen times like this where the market moves so fast. And you can go back on any chart in time and see the big corrections, that if you're not ready to go, by the time you realize that there's a correction underway, you've already missed the bulk of the move and it's no longer an objective entry. So that's that. I've been quite distracted, as you guys know, over the last week or so with a lot of programming changes to the site. As old time would have it, I also upgraded, bought a new trading PC. I still have the other one, but I've been migrating all my files and all that over, and that's been a distraction. But I'm going to focus on the market right now and give you my thoughts here. So this is the S&P 500. I'll only look at the daily charts. I've covered the 60-minute charts quite a bit recently. And as I put up a static post today, here's levels that I'm watching. We have this minor uptrend line right here. You can see it pretty well defined. That's one to watch. And then you have this larger, what I call primary uptrend line to watch. So these are the developments that I'm watching for on SPY. If we break through there, and then you have a pretty key support level here around 240.32. You can see that was the previous highs right here. We had this high. We came up, tested it, failed. Then we had a breakout and a back test over this time period. Okay, I'm kind of getting this chart quite a bit busy here, but I wanted to point out the significance of all these levels. So probably most importantly, are right up there with this primary uptrend line would be that 240 30ish area, because that defined that was a breakout to new highs after several failures there, a successful back test. And like I like to say, the SPY has no business now, if the bullish case is intact, alive and well going forward, has no business. It can certainly come in for another back test. It can certainly come and back test this trend line again, but these are intersecting, just below intersecting key support levels that, if broken, as you know, I've had these charts, these targets on here for a long time now. I don't even know if that's still 5% anymore. Probably is. We might have went up a little when I first put it, and then, yep, came back down. So it's right about 5%, almost on the button. That's my minimum target, and this is a potential. And if this trend line breaks, I'll call this my preferred target, meaning I expect a reaction there, a little bounce, and think that we come down here to 219. We'll call it 220, and that'd be a drop of about 10% in the broad markets. That would be the biggest correction that we've seen all year and in quite a while. So that's that. Again, that these charts are on the front page. There's the cues. Everything that I've talked about, all these divergent highs, and I keep talking about how they do play out. The thing is that the divergent highs in recent months haven't played out for much more than just a pullback that was almost over before you know it. But you have a series of divergent highs. I've talked about this quite a bit, so I'm not going to harp on that anymore. I'll just highlight for those of you that haven't seen the front page post. This is the trend line I'm watching. This is the big boy here. This has numerous reactions going back all the way here to 2015. You can see these reactions off this trend line quite a bit, and we haven't visited that trend line in a while. So at the very least, I expect us to come down and visit that. But trend lines they don't last forever, and the longer they are, um, the more touches you have, the more valid that trend line. So therefore, keep an eye on that. It's got a little ways to go. We're not there yet, but like I said in the beginning of the video, from these periods of low volatility, that's where you can get those very sharp spikes, and that I'm just measuring a couple days in advance. I'm not measuring straight down. So if it took a few days to get there, that's 3%. This market could drop 3% in a single day. And once this momentum breaks and we start to see that the tide is no longer rising, you're going to see people abandoning ship so fast, and it's going to be a crowded exit. So I just don't want to. I'm not trying to sensationalize anything here, but if we see this in a week, a drop like that, don't be surprised. That would wipe out months of gains. That's what I expect to happen. I think it may very well happen. And again, it's right now we have a lot of technical evidence supporting it. We're breaking down on the 60-minute charts, and I'm looking at some key sectors breaking down. So by all means, I don't have an official index short on the site, but I think it's an objective time, and I mentioned that in the trading room to a couple people recently who asked about it. I certainly think it's been objective and still is to put a short on the broad market with a stop over the recent highs. Your risk to reward is very good, when you compare the downside potential to the loss if we go up a little bit. All right, so that's enough on the broad markets. A couple other sectors that stand out to me. Like I always say, if you get a correction in the broad market, you can do a lot better shorting the most bearish sectors. Now, IHI already has been going down. This is an official trade idea on the site. Medical device index fund. Subsector of the healthcare industry. I had a price alert on one today, and I may put this up as an official trade idea. Like this one, Striker. And I covered this in the video a few weeks back. If you go to the front page and on the upper right-hand side, there's that select tag box. Every post on the front page is tagged with any stock, index, commodity, whatever is discussed in that video. So if you just hit that, click that drop down box, type in IHI, boom, and then click on IHI, that ticker. It'll then load all the posts, so that'll bring up that video for you. But you can see here, this one has more meat on the bone than a short on the sector itself. Again, that's SYK Striker. I think this one will look something like this. See quite a bit of downside there, big steep divergent highs, and there's quite a few in there. So again, revisit that video. The point of this video was not to go in detail in any one sector, just to kind of glance over the ones that stand out to me. XHB, because I've been distracted with the site and some other things lately, I haven't updated some of the trade ideas that need updating. I believe we had our stop clipped intraday here on XHB. So officially that was removed, but I did make some comments on the site the other day that I think it still looks good. That was a stop raid, and now we're already at that first support S1 target, and we're actually cracking below it. So this one you could reshort again if you were stopped out, if you're still short. I really like this one. We had another trade idea I didn't update I mentioned it in the trading room or on the front page the other day. Sherwin-Williams hit the first target right here. So that one played out nice. We shorted this one either, I can't recall. Yeah, I think we shorted right after the breakdown and it snapped back and we shorted it on the back test of that wedge. So on the initial, by the time I caught it that day, it was down, but I waited and we were lucky enough to get that kickback to the wedge from below. That is about as objective as it gets, and it turned down. So that one's already profitable. And it's already had a reaction there, and it may hold that level. I mean, I definitely wouldn't short it here. But if you're still short, I do believe that after the typical reaction, what I mean by that is a pause and bounce or consolidation. We've already had 3 days of consolidation, really 4 above that level, or about a week or so. But so we don't have to bounce up. We could just correct in time, a little sideways here on that support. Then once we break that support level, then we head down, hit that next target, possibly that potential third target, but I'm just going to leave this as the official target for now. And there's quite a few. I did, again, if you go find the tag XHB, you'll see the video on the home builders, Toll Brothers, a bunch of them. They're looking good right now. I mean, this was a nice, same reason, XHB was an official trade. A lot of these individual home builders and the related stocks like the Home Depot and Lowe's and Sherwin-Williams, like I just covered, big paint company. They're all going to move roughly in tandem. So there's Toll Brothers, breakdown, a little kickback rally, and now it's just taken out that previous reaction low, and I see that thing easily coming down to probably ultimately down to this $35 level. That's a big steep divergence on that high. So again, there's a lot of ideas there, and I won't even go over the leveraged ETFs. You guys can look those up. I covered that in the video too. And the semis. Now this one, I've been talking on this. I was wrong earlier. Tried to get these guys. What was it, earlier this year? Call a top. A big top is coming in the semis. That I can promise you. And I think it's coming soon. This is well, here's the long-term charts. These have been covered in detail, but when I jump out to this weekly chart, I see extreme overbought conditions. I see a rising price channel ready to go. On this is SOXX. I put up some charts on the front page on these. There you go. You can see that's with an Andrews pitchfork. But here's the primary trend lines I'm watching. These are I did a post the other day. Let's keep it simple. It's covering the semiconductor stocks. This is it. Look at this trend line. Look how well defined, going all the way back to early 2016. SOX is dancing on it. SMH is dancing on it right now. These are just the 3 big ones. I like to get confirmation when all 3 go, because this market has been just relentless and brutal to the shorts on any breakdowns, technicals, good sell signals. We've seen more false sell signals and whipsaw signals in the last 6 months than I can remember in the last 6 years. So that's why I said on the front page post, and I'm saying it now, wait to see this one goes. It's not much farther. We're down 2.33% on SMH today, but we're right on the trend line on SMH and SOXX. However, one of the big ones, XSD, which is the Spider's S&P Semiconductor ETF. Remember, these are all semi ETFs. They're just different companies, so they have different weightings, a little bit different components, obviously a lot of overlap, but you can see there that XSD has already broken down, and I expect the other two to follow suit. And when they do, and this was an impulsive breakdown as well. There's a lot of nice looking semiconductor stocks. I won't go over them all. Let's just look at a few. Let me pull up SOXX. That has a lot of components. Here's some of the ones that stand out. Taiwan Semi. This is the world's largest semiconductor company. Look at this chart. Just a beauty. Here's a trend line. I have to zoom out to a 4-year chart here as it goes all the way back to 2015. You can see this primary uptrend line, very, very well defined. I mean, that's what I like to see in a trend line. The more well defined, the more valid it is, more eyes are watching it. Therefore, when you get a break, the, the greater the chances are that there you'll have some follow through downside. And even the history. If you just look at this thing, just eyeball how well this thing trades. You have a history of these steep, very steep uptrend lines. The stock runs, gets overbought, and at the very least, it's always come back in and visited this trend line. And as I said earlier, no trend lines last forever. This one, you can see the vigor or the strength of this rally is diminishing. These were huge rips. They'd come back in, sharp corrections, hit that, obviously we didn't have the trend line form to that third tag there really, but you can see a pattern. They would come in, correct, and then boom, off to the races again. Come in and correct, boom, off to the races. Now what I see is the momentum has been slowing. It's hugging this trend line. We had one little rip here, and it didn't last very long. It didn't go very far above the trend line like the others. We came back in. This is a stock losing momentum. The PPO is a momentum indicator. You can see it turning down, making a bearish cross. Um, you can see the divergence there on the RSI and everything else. So again, I'm watching that one closely for a breakdown. That's going back a couple years. This trend line now goes to the left. I jump back to a 2-year daily chart, but there's your most recent technicals. You can see just like we had back here in late 2016, bearish rising wedge with divergent high, breakdown back test, 10% correction. Bearish rising wedge with a divergent high, breakdown back test, and it's working its way down. The difference between now and then is this one had quite a bit. It had 10% to fall from top to bottom um, before it even hit the trend line. So when you get way above a trend line, you come back in, chances are that trend line will hold a support. But when that trend gets extended and old, and the correction then comes from not so far above the trend line, odds favor a breakdown versus buying the dip here. So that, if that makes sense to you, there's time to buy a dip, or as a trader, let me just say this: there's times I look to position on pullbacks to support, and there's other times that I look to position to wait for a break of support to position short. It all depends on what the trend is doing now. So let's move on. I guess that's it. You guys can look through the videos. There's a bunch out there. A couple other big ones I'll cover. Nvidia. This thing just looks so ripe for a correction. Here's a big, sharp, well-defined bearish rising wedge. A nice, well-defined trend line. Double negative divergence. You had divergence here. I mean, you had a divergent high here. And again, this speaks to those that's, I've heard comments over the last 6 months or so that technicals don't work, divergences don't play out. They do. That was a 21% correction on that divergent high back there in early 20, that peaked on that top in early 2017. But what happened is the stock went on and made a very impressive rally, but put in a much larger divergent high and even a second consecutive divergent high here. And as I often say, corrections or rallies, if it's bullish divergence for that matter, they are typically commensurate with the scope of the divergences. Meaning, if you get these little divergences on a daily time frame like this, you get a little correction. You get a little bit bigger divergence like we have here. When you put these two lines together, you get a bigger correction, 21% drop. Now we have this very large divergence. It comes on the PPO all the way from back here, and we can see quite a move down in Nvidia. And there's what it looks like, and I'm using a log chart here. If I used take off log scaling, you can see the stock has gone parabolic. Log scaling sort of smooths out the chart. You should always use log scaling on a chart. that any stock that's had such a price move, this one going in the last decade from around $5, $6 a share to 166. If you take it off log scaling, you get a chart. It's parabolic. You can't chart that. You can't make heads or tails of it. And it's also not healthy. We all know how parabolic runs typically end, i.e. March of 2000, techbubble.com, all that stuff. Anyways, this is it. All right, I could go over all of these semis. They look great to me. A lot of them look like nice short trades. But if you want to keep it simple, just use one of the ETFs. There's Broadcom, nice uptrend line. Looks like it's going to come and visit and probably break down. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.